It has been a difficult week for equity markets with the sell-off accelerating on weaker than expected Chinese data. Here to give us some context on what is happening and what he is watching, we are joined by Bruce Cooper. He's Chief Investment Officer at TD Asset Management. Nice to see you, Bruce.
Great to be here.
You and I have talked many times about slower growth and some of the structural headwinds that the global economy is facing right now. Higher volatility, we are certainly seeing that right now. But what specifically is triggering the declines we're seeing right now in everything? I mean, equities, commodities, emerging markets, North American markets, it seems as though everything is selling off.
Yeah, well, first of all, I would note not everything is selling off because actually bonds are actually performing extremely well here. Interest rates have come back down, which means bond prices are actually going up. So, it's important for our clients to keep in mind that if they've got a balanced portfolio, they have part of that portfolio is actually performing extremely well right now. But to get back to the gist of your question, clearly the market is worried about slower growth here. I think it's a clear message being sent by lower equities and lower commodities and lower interest rates is that growth is under question. I think the change in tone is being driven by a different perception of what's going on in the emerging world generally, and I think especially China, where there's concern that growth is even slower than we might have thought previously. We've
been talking about this for a while in terms of what the headlines are saying about Chinese growth. 6, 7, 8% back in the heyday. But I know you look at data and you see a different story. And is that what people are kind of going, oh?
Yeah.
Really, the growth is slow.
Every quarter Chinese GDP is released and they'll tell you that growth is 7%, right on the nose. It never really varies much. But a lot of people, including ourselves, we watch some of the more nuanced data under the surface, things like new car sales, things like electricity production, things like freight rail traffic, because if you're going to make goods, it's probably going to be shipped in a train, or it might be shipped in a train. So we watch some of that data, and a lot of that data would suggest that growth is much, much slower than 7%. It could be anywhere from, let's say, 2 to 4%. It's hard to do it with precision because you don't have enough data.
But that's a lot lower than 6.
It's a lot lower than 6 or 7. And I think that China devalued its currency last week, and I think that was in some ways saying that growth is slower than they had previously announced.
Now, layer on top of that, I mean, this is all related, but oil today I saw with a 30 in the price, so we've dipped below 40. I mean, is this all?
It's been I think it's a consistent part of the story. Slower growth means less demand, which pushes commodities down. I think oil has been particularly hit because in addition to fears about slower demand, you've actually had fairly high levels of production out of OPEC, particularly out of Saudi Arabia, which is producing at record levels despite the low prices. And also out of Iraq. Even though there's actually total chaos in Iraq, they're actually producing quite a lot of oil right now. And so the combination of higher supply out of OPEC and fears of lower demand because of slower global growth is conspiring to push oil to quite low levels. You're right.
Tell me, does this feel different? I mean, because one thing I've noticed is, we see, again, the market seems to be going up and down just on Chinese data. And that's something that just didn't happen as much before. Yeah. So does it feel different to you?
Well, we've had a more cautious outlook really from quite early in the year. We started talking about this in February and March. And the way I think of it, the key underpinnings of that cautious outlook are unfolding. And to me, there are 4 key planks to our cautious outlook. One was slower global growth. The second was low interest rates, which translates to low returns in your fixed income portfolio. The third was decelerating earnings growth. And the final was valuations seemed kind of roughly in the range of fair value for equities. And so I think what we've been talking about here with China really is on that first of those points, which is slow global growth. Is it a little different? I think is what you're asking. And I think it's just exacerbated. We've been focused mostly on the slow growth in Europe, in Canada, to some extent in the United States, although it's obviously doing a bit better. So really in the developed world, but I think what we're seeing now is the emerging world is joining the party, which is probably the wrong expression here, but it's joining the crowd in having slower growth.
Now, you and I talked. I remember it was several months ago now, when you made the move at TD Asset Management to go from overweight equities to neutral. What do you do? I mean, for people who are watching though right now, I mean, from here on in, what are you doing?
Yeah. So first of all, we're now pleased that we made that move. That happened back in February, March, and I just talked about the reasons we did that, and all those reasons we were fortunate enough to anticipate some of them, and now equities are pulling off a little bit. We felt that it was not the right time to be as optimistic as we had been for the previous 5 years. The risk reward is not as attractive, and you wanted to be more balanced. You wanted to have more diversification, which is provided by bonds, for example. As I said at the top of the piece, they actually go up in this kind of environment, so it's good to have more of those. Also, exposure to the U.S. dollar helps you in this environment. If not everything's going down, actually, U.S. dollar has been quite strong year to date. So, from here, I think we're comfortable with our positioning. We're fortunate we got cautious earlier, so we don't have to press the panic button here. We've been emphasizing that diversification, a balanced portfolio of quality assets, have some bonds, have some U.S. exposure, have some high-quality dividend-paying stocks. I think that should position you well to navigate this tougher environment. In
amongst all this that's going on and a lot of the sea of red we're seeing in terms of the markets, it's notable that U.S. markets are selling off, but the underpinnings still look pretty positive. Very strong U.S. housing market. You're still seeing some pretty good numbers there. So how long do you think the U.S. economy decouple, or I won't say the markets aren't decoupling, but the economy seems to be pretty good.
I think fundamentally the U.S. economy is in better shape. We've seen the U.S. consumer deleverage a little bit. The U.S. is still...
I'm noting caution here too.
No, I think, it's this, I've used the analogy of a car. Some people have heard this before. The global economy, and the U.S. fits this too, is like an economy in third gear. It can't get to fourth or fifth gear. I think the U.S. economy is the same. It's growing at 2%. It's not growing at 4%. It's growing at 2%. But I think, the underpinnings are still pretty good. The housing market's good. The jobs market is good. The U.S. is still the center of the global technology industry, which is very important. So, I think we're optimistic about the U.S., but of course, it's only one piece of the whole global puzzle.
Bruce, thanks very much.
Great to be here.
Bruce Cooper, Chief Investment Officer at TD Asset Management. I'm Kim Parlee. Thanks so much for watching.